Welcome back to our class. In the prior videos, we have learned various ways for companies to contract its business, including divestitures, spin-offs, split-offs, and equity carve-outs. These approaches are different in light of their tax consequences, ownership structures, whether the parent retains control of the subsidiary, and whether cash flow can be generated. In this video, we will discuss the last topic in corporate restructuring, which is split-ups. A split-up also breaks the parent company into two or more independent companies via IPOs. And the parent company no longer exists at the end of a split-up. But different from other restructuring strategies we have discussed, the parent will be replaced by the newly formed companies in split-ups. Split-ups and spin-offs share some similarities. First, after a split-up, old shareholders will receive shares in the new companies on a prorated basis, so the ownership structures of the new companies will be the same as in the case of a spin-off. Secondly, split-ups also have no tax consequences and no cash transactions are involved. An example of a split-up is the breakup of ITT, International Telephone and Telegraph Company, in year 1995. During the 1960s and 1970s, ITT had acquired more than 215 companies to build a conglomerate. The business scope of ITT expanded far beyond telecommunication. The ITT conglomerate operated across industries, hotels, sports, finance, etc. And companies acquired by ITT include Avis Rent-A-Car, Continental Baking Company, Sheraton Hotels, Hartford Insurance Company, and others. ITT's inter-industry integration could result in diversification discount. On June 13, 1995, the ITT Corporation announced to split up into 3 new public companies by separately listing them on the New York Stock Exchange. The 3 new companies include ITT Hartford, an insurance company, ITT Industries, an industrial product firm, and ITT Corporation, a casino, hotel, and sport company. Each of the 3 companies would be operated under its own management and board of directors. Holders of ITT stock received 1 share of stock in each of the new companies. According to Rand Arascott, who was the then chairman, president, and CEO of ITT, having these 3 companies acting and operating and being evaluated in their own business environment will provide investors, analysts, and those who deploy that a similar, more clear way to evaluate us. A more recent example of split-up is the case of United Technologies in 2018. United Technologies used to operate in numerous areas, including aircraft and aerospace, elevators and escalators, heating and air conditioning, refrigeration, and others. On 26th of November 2018, United Technologies was split up into 3 separate companies: United Technologies, oldest elevator company, and carrier. While one of the new companies inherited the name United Technologies, it's an entirely new company, more sharply focused on aerospace. The split-up of United Technologies was believed to be persuaded by 2 activism hedge funds, Third Point and Pershing Square Capital Management. Upon announcement of the news, the share price of United Technologies went up by 2.2%. The positive stock market return suggested that the split-up of United Technologies was favored by its shareholders. And according to Gregory Hayes, the CEO of United Technologies, our decision to separate United Technologies is a pivotal moment in our history and will best position each independent company to drive sustained growth. The breakup of large conglomerates supports the belief that sometimes companies need to stop expanding because the sum of the parts of the company as independent entities could worth more than the value of them when housed under the same umbrella. Okay, in this video, we have discussed split-ups, which is our last topic in corporate restructurings. Thanks for watching. In the next week, we will move on to trading business of investment banks.